A hidden wealth transfer is quietly moving toward 47 million Americans, and it is set to accelerate in the next 30 days. If you depend on retirement savings, collect monthly benefits, or still carry a balance on your home loan, the next 4 weeks will determine whether you protect what you have built or watch it silently erode over the coming decade. What is about to unfold has happened only once before in American history, and almost nobody saw it coming that time either. On May 15, 2026, a major shift takes effect in how the United States manages its staggering debt load. The mechanism being activated is the very same one used between 1946 and 1974 to wipe out 2/3 of federal obligations, without Congress ever casting a single vote to pay down $1 of principal. During those 28 years, savers who followed every piece of conventional financial wisdom lost roughly 40% of their purchasing power. Meanwhile, borrowers locked into fixed-rate obligations watched the real value of their debt cut nearly in half, automatically without lifting a finger. The phrase that signals this shift has now appeared twice in recent Senate testimony. It had not appeared in any official federal communication in over 4 decades. That phrase is financial repression. And if you do not understand what it means, you are about to become significantly poorer without ever seeing a single number go down on any statement you receive. Financial repression is the deliberate suppression of interest rates paid to savers, held artificially below the actual rate of inflation, forcing depositors to bleed purchasing power year after year, while the government and every holder of fixed-rate debt watches their real obligations shrink automatically. This is not theory. This is not speculation. This is documented, deliberate historical policy that worked precisely as designed for nearly 3 decades, and is now being reactivated because the federal balance sheet has reached a point where no other politically viable solution exists. Here is the part that will genuinely surprise you. The people who stand to lose the most are not the ones with the smallest savings. The people who will lose the most are the ones who spent the last 40 years doing exactly what every mainstream financial expert told them to do. Pay off all debt as fast as possible. Keep your emergency fund in a federally insured bank account. Build your retirement portfolio around safe, long-term bonds. Every single one of those decisions is about to become a structurally losing position for the next decade. The people who will come out ahead are the ones holding the exact assets that financial advisors have been telling retirees to get rid of. Fixed-rate mortgages at any interest rate below 5.5%. Inflation index securities that most investors have never even considered, and hard assets that generate income tied to real-world price increases rather than nominal dollar figures. In the next several minutes, you are going to learn 4 specific moves to make right now, the 3 retirement asset categories most likely sitting in your portfolio today that get systematically destroyed under this framework. The one government-backed instrument that 94% of retirees are eligible to purchase, but fewer than 8% actually own, and the single decision that transforms a recoverable situation into a permanent, irreversible loss of retirement purchasing power. To understand what is coming, you need to understand what already happened. Between 1946 and 1974, the United States faced a problem that is structurally identical to the one it faces today. Federal debt had climbed to 121% of gross domestic product in the wake of World War II. There were only 4 realistic paths forward: explicit default, massive tax increases, deep, painful spending cuts, or a hidden transfer of wealth from savers to borrowers through sustained negative real interest rates. The government chose the 4th option because it was the only one that required no congressional vote and generated no visible political backlash. The mechanics were straightforward: keep the interest rate paid on government bonds and federally insured bank deposits below the actual inflation rate for as long as necessary to erode the real value of outstanding debt. A saver who placed $10,000 in 1946 into the safest instrument available, a federally insured bank account, received roughly 1.5% annual interest, while actual inflation ran between 3% and 6% per year. By 1974, that original $10,000 had grown to approximately $14,700 in nominal terms. But in real purchasing power, it was worth the equivalent of just $6,200 in 1946 dollars. The saver lost 38% of their wealth, while doing precisely what every government institution and financial professional told them was the safest, most responsible thing to do. During that same period, a borrower who signed a 30-year fixed-rate mortgage in 1946 at 4% watched the real value of their outstanding principal collapse by approximately 60% by 1974. They repaid the loan in dollars worth a fraction of what they originally borrowed. The lender absorbed the loss. The federal government was the single greatest beneficiary. Debt that stood at 121% of GDP in 1946 fell to 31% by 1974, without a single year of budget surplus large enough to pay down the principal. The entire reduction came from inflation steadily eroding the real value of outstanding obligations while nominal interest rates were held below the inflation rate. That is financial repression. It is not a collapse. It is not hyperinflation. It is not a stock market crash. It is a slow, deliberate, continuous transfer of wealth from savers to borrowers, happening quietly over years in a way that is nearly impossible to detect unless you know exactly what to look for. Let me show you 3 portraits of real retirees and what this framework does to each of them. The first is Patricia. Patricia is 72 years old. She lives in a modest condominium she paid off completely in 2015. She collects $2,900 per month in Social Security benefits plus a small pension. After her husband passed, she combined his life insurance payout and proceeds from the sale of a vacation property into a single federally insured savings account. The current balance is $81,640. Her account pays 4.2% annual interest, which sounds reasonable until you look at the inflation rate that actually affects her household. The headline Consumer Price Index over the past 12 months ran at 3.1%. But the Consumer Price Index for elderly Americans, calculated separately by the Bureau of Labor Statistics to account for the higher share of medical expenses and housing costs in senior budgets, ran at 5.7% over the same period. Patricia's real return, after adjusting for the costs that actually affect her life, was negative 1.5%. She lost approximately $1,224 in purchasing power last year, and it did not appear on any statement she received. Her financial advisor did not call. There was no mechanism to alert her unless she went looking for the alternative inflation index herself. Under the framework now being implemented, that negative 1.5% annual real return becomes the design target for the next 10 years by explicit policy. The Federal Reserve and the Treasury Department will coordinate to keep nominal rates on government debt and federally insured deposits below actual inflation. Patricia cannot escape this by switching banks or hunting for a higher yield account. Every federally insured savings instrument is subject to the same nominal rate suppression. Over the next 10 years, if inflation averages 5.5% annually and her savings account continues paying 4.2%, Patricia will lose approximately $27,000 in real purchasing power from that single account alone. The second is Robert. Robert is 67 years old and lives outside Phoenix, Arizona. He receives $2,930 per month in Social Security, a small disability check, and carries a 30-year fixed-rate mortgage from 2021 at 3.2%. The remaining principal is approximately $140,000. Following conventional financial advice, Robert has been making extra principal payments of $200 per month for the past 4 years, working to retire the mortgage early and eliminate all debt before he turns 75. Under financial repression, Robert's mortgage is the single best asset he owns. And every extra principal payment he makes is a voluntary transfer of his own purchasing power directly into the bank's balance sheet. If inflation averages 5% over the next 10 years and his mortgage rate stays fixed at 3.2%, the real value of his outstanding principal declines by approximately $50,000 simply by holding the debt and making only the minimum required payments. No extra effort, no additional risk. Inflation does the work. Every dollar Robert sends above his minimum monthly payment eliminates that structural advantage. The $200 per month he has been forwarding to the bank could instead be redirected into inflation-protected instruments that actually preserve purchasing power. The mortgage interest deduction also becomes more valuable in real terms as inflation rises, because the deduction is calculated on nominal interest paid, while the actual cost of that interest falls as inflation accelerates. The third is David. David is 69 years old and lives outside Chicago. He receives $2,100 per month in Social Security and holds approximately $190,000 in a portfolio concentrated in 20-year and 30-year Treasury bonds. His advisor recommended this structure as the safest possible allocation for a retiree who cannot afford to lose principal. Under financial repression, long-duration fixed income is the asset category that suffers the most damage. And David's portfolio is positioned for maximum exposure. As inflation runs above the bond yield, every coupon payment David receives buys less in real terms. As the framework persists, the market price of his existing bonds falls if he ever needs to sell before maturity. His real return will be mathematically engineered to run at -2% to -4% per year over the next decade. Over 10 years, David's $190,000 portfolio could lose between $60,000 and $95,000 in real purchasing power, even as the nominal balance appears stable or edges slightly upward. The advice that worked beautifully for retirees in the 1980s and 1990s becomes the most dangerous possible advice under the framework now being implemented. During those decades, the Federal Reserve fought inflation by keeping interest rates high, which rewarded savers and punished borrowers. That framework has now been reversed, and almost no one in the financial advisory industry has updated their recommendations to reflect it. Now let us talk about what you can actually do. 4 specific moves starting right now. Move 1, audit your fixed income exposure. Pull every retirement, bank, and brokerage statement you currently hold. Write down the total dollar amount sitting in cash savings accounts, certificates of deposit, money market funds, short-duration Treasury notes, intermediate Treasury notes, long-duration Treasury bonds, corporate bonds, and bond mutual funds. Add those numbers together. That total is your fixed income exposure. For the typical retiree, that figure represents between 60% and 90% of total retirement assets. Under financial repression, that entire allocation is structurally engineered to lose real value, year after year, quietly and without warning. This audit takes about 15 minutes. It costs nothing. Do it today. Move 2. Stop accelerating your mortgage payoff. If you currently hold a fixed-rate mortgage at any interest rate below 5.5%, stop making any payment above the contractual monthly minimum. Reset your payment immediately and redirect the difference into a different category of asset. Your fixed-rate mortgage is the only common debt instrument that is structurally engineered to benefit the borrower under financial repression. If your mortgage rate is 3.5% and inflation averages 5.5% over the next 8 years, the real value of your outstanding principal declines by approximately 35%, simply by making minimum payments and allowing inflation to do its work. You are not taking on additional risk. You are letting the environment work in your favor. For most retirees over the next decade, the mortgage is not a liability. It is an asset. Move 3. Shift fixed income holdings into inflation-indexed instruments. There are 2 instruments available to everyday retail investors that provide explicit, built-in inflation protection. The first is Series 1 savings bonds, commonly called I-bonds. Purchased directly through the Treasury Department website, they adjust their interest rate every 6 months based on the official Consumer Price Index. The interest is exempt from state and local income tax. The annual purchase limit is $10,000 per person electronically, plus an additional $5,000 if you elect to receive your federal tax refund in paper bond form. A married couple can therefore move $30,000 per year out of low-return savings accounts and into inflation-indexed instruments. The second is Treasury inflation-protected securities, known as TIPS. These can be purchased through the Treasury website or through any standard brokerage account. TIPS adjust their principal value every 6 months based on the CPI. They are available in maturities of 5, 10, and 30 years. Unlike I-bonds, there is no annual purchase limit. The correct sequence: max out I-bond purchases first, because the tax exemptions make them more efficient than TIPS for most households. After reaching the annual I-bond limit, move additional funds into a TIPS ladder with maturities that match your expected liquidity needs. A 70-year-old retiree with $150,000 in certificates of deposit should immediately move $10,000 into I-bonds, and if married, the spouse should do the same. The remaining $130,000 should be repositioned into TIPS spread across 5, 10, and 15-year maturities. Move 4. Verify your pension's inflation adjustment. Social Security adjusts automatically every year based on the Consumer Price Index. That adjustment is statutorily protected. It cannot be eliminated without an act of Congress. Most pensions, including the vast majority of corporate pensions and many state and local government pensions, include no automatic inflation adjustment whatsoever. If your pension carries no adjustment, the real purchasing power of your monthly benefit will decline every single year for the rest of your life. A pension paying $1,500 per month today with no inflation protection will have the purchasing power of roughly $900 per month in 10 years, if inflation averages just 5% annually. Call your pension administrator and ask one specific question. Is my benefit adjusted annually for inflation, and if so, by which index? If the answer is no, your pension is functionally identical to a long-duration bond, and you need to build additional inflation protection elsewhere in your portfolio to compensate. Now let me share the tax strategy that 94% of retirees completely overlook. Internal Revenue Code Section 135 provides a federal income tax exemption on the interest earned by Series 1 savings bonds, when those bonds are used to pay qualified higher education expenses for the bondholder, their spouse, or a dependent. For retirees with grandchildren approaching college age, this is the most tax-efficient transfer of inflation-hedged wealth between generations available to any American household. Here is how it works. You purchase I-bonds in your own name or jointly with your spouse. You hold them until your grandchild is approaching college enrollment. When the time comes, you redeem the bonds and apply the proceeds directly to qualified tuition and fees at the educational institution. The interest accumulated during the holding period, which under financial repression will likely run at 5% to 7% annually over the next decade, is completely exempt from federal income tax. It is already exempt from state and local income tax, regardless of how the bonds are ultimately used. For a married couple earning $60,000 combined from Social Security and pension income, this exemption is available in full. If they purchase $10,000 in I-bonds each year for 10 years, and those bonds grow to $190,000 through inflation adjustments, the entire $90,000 in accumulated interest can be withdrawn completely tax-free if applied to qualified education expenses. No other common investment vehicle offers federal tax exemption on interest income for middle-income households. Now let me describe the single mistake that turns a recoverable situation into permanent, irreversible destruction. The worst decision a retiree can make under financial repression is to panic sell long-duration bonds or bond funds in a taxable account during a period of falling bond prices, without understanding the tax consequences or repositioning into inflation-protected alternatives. Here is exactly how this plays out. As inflation rises and the Federal Reserve allows interest rates to drift modestly upward, the market value of existing long-duration bonds falls. A 30-year Treasury bond issued in 2023 at a 4% yield will trade at a meaningful discount if new 30-year bonds are issued in 2027 at 5.5%. A retiree holding $100,000 in a long-duration bond fund watches the balance drop to $85,000. Alarmed, they sell, locking in a $15,000 loss. They now have $85,000 sitting in a money market account earning 4%, while inflation runs at 5.5%. They have converted a bond position that was losing real value slowly into a cash position that loses real value at exactly the same rate, while also triggering a taxable event. The panic accomplished nothing except formalizing the loss. The correct sequence is to sell long-duration bond positions in tax-advantaged accounts first, where capital losses generate no taxable event, and immediately reinvest the proceeds into inflation-protected securities. In taxable accounts, long-duration positions should be sold in stages across multiple calendar years to manage the tax impact, with proceeds moved directly into TIPS or I bonds rather than parked in cash. The difference between executing this sequence correctly versus incorrectly can represent $40,000 to $80,000 in purchasing power over a 10-year period for a retiree with a $200,000 portfolio. On May 15, 2026, formal implementation of the new framework begins with coordinated policy announcements from the Federal Reserve, the Treasury Department, and key regulatory agencies. These announcements will not use the phrase financial repression because that phrase carries weight. Instead, the language will emphasize economic stability, sustainable growth, and maintaining interest rates that support employment and investment. The actual mechanism will be a commitment to purchase government securities in sufficient quantities to prevent yields from rising above a specified target range. The political cost of financial repression is nearly zero, because the losses are diffused across millions of individual savers and accumulate slowly enough that most people never identify the cause. A retiree who loses $30,000 in purchasing power over 10 years may watch their nominal account balance grow slightly and conclude they are doing fine. The reason the next 30 days carry unique importance is this. Once the framework is formally announced and implemented, the market for inflation-protected securities will reprice immediately. TIPS yields will fall as institutional investors rush to reposition. I-bond purchase limits will prevent most households from moving significant sums quickly enough to matter. Right now, before the formal announcement, TIPS are available at yields that still offer meaningful real returns. I-bonds can be purchased at current rates before a surge of competing institutional demand arrives. A retiree who waits until June to begin repositioning will find TIPS yielding 0.5% to 1% less than they yield today. Across a 10-year holding period, that gap represents a loss of $8,000 to $15,000 per $100,000 invested. The people who reposition in the next 4 weeks will lock in inflation protection at the most favorable terms available. That window is open right now. It will not stay open. Let me leave you with a clear summary of where each category of asset stands. Losing assets under financial repression. Cash in federally insured savings accounts. Certificates of deposit, money market funds, treasury notes, treasury bonds, corporate bonds, bond mutual funds, any pension or annuity with a fixed monthly payment that carries no inflation adjustment. Winning assets. Fixed-rate mortgages at any rate below 5.5%. Series Y savings bonds. Treasury inflation-protected securities. Real estate generating rental income indexed to inflation. Equity positions in companies with sufficient pricing power to pass cost increases to their customers. Protected assets. Social Security benefits, inflation-indexed pensions, inflation-indexed annuities, deferred compensation agreements with cost of living adjustments tied to the Consumer Price Index. One final piece of historical context that almost everyone ignores. Between 1946 and 1951, the Federal Reserve held Treasury yields at a hard cap of 2.5% for long-term bonds, while inflation ran between 3% and 8% annually. During those 9 years, savers holding government bonds lost approximately 25% of their purchasing power, while the federal government reduced its debt burden by an equivalent amount in real terms. The current situation differs in one critical respect. The post-war period featured a young, growing population entering peak earning years, economic growth that partially cushioned the blow to savers. The 2026 to 2036 period features an aging population moving into retirement with declining labor force participation. That growth cushion will not be present to the same degree. The losses to savers will be more severe because retirees cannot increase their labor income to compensate for what inflation takes away. Here is your complete action checklist. 1. Complete the fixed income audit. You need to know your exact exposure before you can reposition effectively. 2. Stop any accelerated mortgage payments immediately and redirect that cash flow to I-bonds or TIPS. 3. Open a Treasury direct account if you do not have one. The setup process takes approximately 20 minutes and requires your Social Security number, bank account information, and mailing address. 4. Max out I-bond purchases for yourself and for your spouse if you are married. 5. Reposition long-duration bond holdings into TIPS or short-duration bonds in stages across the next 90 days. 6. Call your pension administrator directly and verify your benefits inflation adjustment status. 7. If your pension carries no inflation adjustment, calculate the purchasing power loss you will face over the next 10 years and build a compensating position in inflation-protected securities. 8. If you work with a financial advisor, schedule a dedicated meeting specifically to discuss financial repression, TIPS, and I-bonds. If your advisor dismisses the topic without a substantive conversation, find a different advisor. The next 30 days are not the only window to act, but they are the window where the terms are most favorable. Every week of delay reduces the benefit you can capture and raises the cost of protection. If this information gave you something real to work with, share it with one person who needs to hear it. The difference between acting now and acting 6 months from now could represent 5 years of financial security in retirement.